Ladies and gentlemen, right now silver is sitting at roughly $77 an ounce. Most people scroll past that number, but here's what they don't see. We are in the 6th consecutive year of a structural silver deficit. Industrial demand from solar and AI is exploding, and the gold-silver ratio is screaming that silver is the most undervalued asset on the planet right now. Bitcoin gets the headlines, silver gets the gains, and 99% of people will miss it completely. Let me be straightforward with you, because most people in this industry won't be. The silver market is broken. Not broken in the way that makes headlines, not broken in a way that triggers emergency meetings on Wall Street. Broken quietly, structurally, in a way that has been building for 6 consecutive years now and continues to widen while the financial media talks about interest rates and tech stocks. We are in a physical deficit. That means the world is consuming more silver than it is pulling out of the ground and recycling combined every single year. And not by a small margin. The gap between supply and demand is expected to widen by another 15% this year alone, bringing the shortfall to over 46 million ounces. 46 million ounces that simply do not exist to satisfy real-world demand. You cannot print silver. You cannot conjure it from a spreadsheet. When it is gone from the market, it is gone. Now, here is what most investors fundamentally misunderstand about silver that they would never misunderstand about, say, oil or wheat. Silver is not primarily a monetary metal anymore in the eyes of industry. It is an industrial metal with a monetary history. Solar panels require silver. Every electric vehicle on the road requires silver. The semiconductors powering artificial intelligence data centers require silver. The medical devices keeping people alive require silver. This is not speculation about some future demand. This is current contractual locked-in demand from manufacturers who have already placed their orders and built their production lines around silver availability. And here is the cruel irony of the silver market that nobody bothers to explain. Roughly 70% of silver mined globally comes as a byproduct of mining other metals, copper, zinc, lead. That means when silver prices rise, you cannot simply flip a switch and produce more silver. The miners producing it are chasing copper. Silver comes along for the ride. So even in a price environment where silver is screaming higher, the supply response is slow, muted, and largely outside the control of the silver market itself. That structural reality is what separates silver from almost every other commodity on Earth. I have been studying this market for over 30 years. I have seen cycles come and go. I have watched silver get dismissed at $8, at $15. The story was always the same: too volatile, too niche, too small. And yet here we are with institutional demand accelerating, with sovereign nations accumulating physical metal, with the solar industry alone projected to consume a record amount of silver this year, and people are still sleeping on it. The gold-silver ratio right now is telling you something that charts and analysts' reports rarely say out loud. When gold trades at nearly 75 times the price of silver, history is sending you a very clear message. That ratio has averaged far lower over centuries of monetary history. Every time that ratio has stretched to these extreme levels, silver has eventually moved to close the gap. And when it does not close it politely. It closes it aggressively, rapidly, and it rewards those who were positioned early, far beyond what they anticipated. The mainstream financial world does not cover this. Your broker probably has not mentioned it. The financial television networks are not running segments on silver deficits. They will, but they will run those segments after the move has already happened, after the patient and the informed have already captured the majority of the gain. That is how it always works. The crowd arrives at the party after the best food is already gone. What I want you to understand is that deficits of this nature do not resolve themselves gently. Markets absorb shortfalls through one mechanism and one mechanism only: price. Price rises until either demand is destroyed or new supply becomes economically viable. Given that silver demand is embedded in the green energy transition and the technology infrastructure of the next decade, demand destruction is not a realistic outcome at current prices, which means the pressure valve is price. And that valve has a long way to go before it releases the pressure that 6 years of structural deficit have built inside this market. I want you to think back to 2013. Bitcoin was trading somewhere between $13 and $200 depending on what month you caught it. The people who understood what it represented: a fixed supply, a decentralized ledger, a monetary system outside government control, those people were buying it while everyone else was laughing at them. Their coworkers laughed. Their financial advisors told them it was a scam. The mainstream press ran story after story about how it was a tulip mania, a Ponzi scheme, a digital illusion with no real value. And the people who held through all of that noise, who understood the fundamentals before the crowd arrived, those people changed their financial lives permanently. I am not here to tell you that silver is Bitcoin. They are fundamentally different assets with different roles and different mechanics. But I am telling you that the setup, the psychological setup, the valuation setup, the timing setup, rhymes in a way that serious investors should not ignore. Right now, silver is misunderstood, underowned, and underpriced relative to its actual supply and demand reality, just like Bitcoin was in 2000. The difference is that silver has 5,000 years of monetary history behind it, industrial applications that are expanding by the year, and a physical scarcities that no algorithm or mining difficulty adjustment can manufacture. Silver's scarcity is geological. It is baked into the earth itself. When I say silver is in price discovery, I mean that genuinely and precisely. We do not yet know what silver is worth in a world where the dollar has been debased at the rate it has been debased, where central banks have expanded beyond anything previously imaginable, where the green energy transition is locking in industrial silver demand for the next 30 years. The market has not fully priced any of those realities yet. That is what price discovery means. It means the market is still in the process of figuring it out. Bitcoin had its price discovery moment, and it was violent, and it was fast, and it created enormous wealth for those who were early. Silver's price discovery is happening right now, but it is happening in a market that moves differently. A physical market, a market with real industrial stakeholders, a market where the disconnect between paper price and physical reality can only hold for so long before it snaps. Consider where silver was just a few years ago. Consider where it is now. And then consider what a genuine repricing looks like when institutional money, which is only beginning to look seriously at this asset class, decides to move even a fraction of its allocation into physical silver and silver equities. The market is not large enough to absorb that flow without a significant price response. This is basic supply and demand applied to a market that most institutional portfolios have essentially zero exposure to. The people who were early to Bitcoin were not necessarily smarter than everyone else. They were paying attention to something that most people had decided was not worth their attention. They did the work. They understood the underlying mechanics. They held conviction when the crowd was indifferent or hostile, and they were rewarded for that patience in a way that few investments in modern financial history have rewarded early believers. The parallel I am drawing is not about price targets or percentage gains, though the math on silver's undervaluation relative to gold and relative to its production costs is compelling by any serious analytical measure. The parallel's about the moment, about recognizing where you are in a cycle before the mainstream narrative catches up to the reality on the ground. Most people will read about silver's move in a newspaper headline after it has already happened. They will hear about it from a friend at a dinner party when the price has already reflected the fundamentals that exist today. They will wish they had paid attention sooner. That is not pessimism. That is pattern recognition built on decades of watching how markets actually work versus how people assume they work. You are not too late to Bitcoin in 20. You are exactly there right now with silver in 20. The only question worth asking yourself is whether you are going to be the person who recognized it or the person who watched it happen. There is a conversation happening right now in investment circles that frustrates me every time I encounter it. People are framing silver and Bitcoin as competing assets, as if you must choose a side, as if owning one means you are against the other. That framing is not just intellectually lazy, it is financially dangerous because it causes people to miss the distinct and separate role that each of these assets plays in a properly constructed portfolio for the world we are actually living in. Let me be precise about what Bitcoin is. Bitcoin is a remarkable technological achievement. It is a fixed supply, decentralized, censorship-resistant store of value that operates outside the traditional banking system. I have respect for what Satoshi built. The monetary properties are genuine, the scarcity is mathematically enforced. For people who understand what it represents and why it exists, it makes sense as part of a diversified approach to protecting and growing wealth outside the collapsing confidence in fiat currency systems. I am not dismissing it, I am contextualizing it. But here's a critical distinction that most people glossing over this topic refuse to sit with long enough to understand. Bitcoin's floor is built on belief, network adoption, and continued institutional participation. Those are real forces. They are powerful forces, but they are forces that can reverse. We saw it happen when institutional risk appetite contracts, when macro conditions tighten, when the broader market goes into a de-risking cycle. Bitcoin moves with risk assets. It always has. It pulled back 25% from its highs earlier this year, while silver and gold were receiving safe haven inflows from the same capital that was exiting digital assets. That is not a coincidence. That is the market telling you something about the fundamental nature of each asset. Silver's floor is built on something different. It is built on physics. It is built on the periodic table. You cannot replicate silver's electrical conductivity. You cannot substitute away from it in solar cells without meaningful efficiency losses. You cannot build the semiconductor architecture that the artificial intelligence revolution demands without silver. The industrial floor underneath silver is not a matter of sentiment or adoption curves or network effects. It is a matter of the physical laws that govern how electrons move through conductive material. That floor does not disappear during a risk-off event. That floor does not reprice because a large fund decided to take profits. Now, I want to be clear about something because nuance matters in this business. I am not telling you that silver cannot fall in price. Of course it can. Markets overshoot in both directions, and silver is no exception to that reality. What I am telling you is that the reason it holds value and the mechanism through which it holds value is categorically different from Bitcoin's mechanism. And in a world of increasing geopolitical instability, currency debasement, and structural supply constraints, that difference matters enormously. The sophisticated investor of this era is not choosing between silver and Bitcoin. The sophisticated investor is understanding what each one does and sizing accordingly. One is a bet on the continued expansion of the digital financial system and the network effects of the world's dominant cryptocurrency. The other is a bet on the physical world, on energy, on manufacturing, on the irreplaceable role of a metal that civilization literally cannot function without at its current level of technological development. What concerns me about the 99% who are missing this is not that they chose Bitcoin over silver or silver over Bitcoin. What concerns me is that they have not thought carefully enough about either one to understand why both deserve a place in serious wealth preservation strategy right now. They are reacting to price action and headlines rather than thinking through fundamentals and monetary history. The assets that have survived every empire, every currency collapse, every financial crisis throughout recorded human history are physical and tangible. Gold and silver have that track record. Bitcoin is building its track record in real time and doing so impressively. But track record matters. Centuries of functioning as money and store of value through the complete collapse of multiple civilizations, that is not a small thing to dismiss in favor of something that has existed for less than 2 decades. Hold both, understand both, but never confuse them. Network with nature. One was engineered by man. The other was forged in the heart of a dying star billions of years before any human being existed to assign it a price. That is silver's floor. And no market cycle, no institutional rotation, no risk-off event has ever been able to permanently breach it.